Hi everybody, it's Bob Iaccino, your portfolio manager, I should say co-portfolio manager, with Mike Arnold for the Stock Think Tank. And Mike has already sent me over 200 stocks to look at for January, including one that you're going to get in this alert, in the alert that this video is attached to, for Foot Locker. Foot Locker looks to be a good long, and we're fulfilling what I said in the last video, that even though we're winding down the year, we're still within our process, even though it's holidays, even though things are slow, of stocks that could potentially perform for you as we break into the new year. So watch for that Foot Locker alert. That should be in this email or the next. Could be in a separate email, depending on where they put it. But check out that Foot Locker recommendation, because I think that's going to be a good one. Having said that, we covered a couple of stocks over the past week. One was CBS, which we covered at a small loss, again, about a third, maybe half of what our allotted loss would normally be. And then we had a couple of gains. We're going to finish the year somewhere around a 71 or a 72% win rate with a reward to risk ratio of about 1.6 to 1. So in other words, for every dollar of risk we take, we make about $1.60. And for every trade that we take, well, we win about 72% of the time. So you can do the math yourself, but that is a very positive money factor, and money factor is very important in strategy and in process. And I could probably explain the money factor in another video, but you have to have a positive money factor to make money over time. And we have a very positive money factor in the Stock Think Tank. So with that aside, we got new highs today in the equity markets. It is Monday, the 28th. We get the start of the Santa Claus rally. For those of you that aren't sure what that is, a Santa Claus rally is a rally that generally takes place, and there is historical precedent for it, between Christmas and New Year's, in that week of trading between Christmas and New Year's, low volume trading. But if you want to remember when that actually is, just remember that Santa Claus has to actually deliver the rally before you can enjoy it. So it's after Christmas. It's not on Christmas or a couple days before, which some people seem to think is the old axiom. Another old axiom that we've seen work quite a bit is buy the rumor, sell the fact. We got the stimulus today, and it doesn't really look like that was a buy the rumor, sell the fact. We did get the president signing it over the holiday weekend. But if you look across, you're starting to see rising yields in the 10-year. You're starting to see a little bit of a rally in the dollar. Things like that are kind of signs that the Santa Claus rally might taper off as we get into the new year. We have very few positions on right now. We've got Lowe's, which is about a third of the way to its profit target. It's positive right now. Still have silver in the special plays, but those of you that are not members of the Stock Think wouldn't have gotten that silver. That is also pretty well profitable for us right now. And then you're gonna get this Foot Locker recommendation. So we're starting to build to get the portfolio filled up in January, when I think we're going to get a sell-off. I actually believe that the yields are going to start to rise, and that's going to push stocks down, because what's going to be the next catalyst? We're going to have the inauguration of Joe Biden, January 10th. He'll start to work on another stimulus plan, but especially if the Republicans have the Senate, it's not going to come right away. And we're certainly not going to get earnings right away, because we're going to have to come out of lockdowns. And a lot of these businesses are not reopening. I could go ahead and list ones that I know personally that aren't reopening. So we're going to have a slowdown, and we're likely to have higher rates coming into the year as the 10-year and some of the other maturations across the curve start to rise in yield. We got the 10-year yield going up to 95.5 basis points today, which is around the high of the month of December in terms of settlement. So we'll see where that settles. And you're getting, again, a little bit of a flattening of the curve. One of the worst things you can have is higher rates with a flatter curve, because that means people are paying higher interest rates, but the banks aren't necessarily making more money. This way, if they have higher profits, they can lend it, and it's stimulative to the economy. So we are a little bit cautious right now, not deliberately, but our process kind of takes care of that for us. Because when we can't find good trades for you guys, that means that a lot of things are overextended. And when things are overextended, in Mike's actual filters that he runs, the screens that he runs to find stocks, the times that he can't find stocks, he'll talk to me and he'll be all stressed out about it. And I'll actually kind of have to talk him down and make him realize that his own process wasn't designed to find times where the markets were extended, But historically, that's kind of what happens. When we can't find trades, it's likely that the market is extended. We're going to come out with our full year performance on the year. Something else, there was an article in the Wall Street Journal about how retail investors are starting to be leveraged. They're actually leveraged debt, margin debt is at a record high. That means if we do get a turnaround, there's going to be margin calls that a lot of retail investors likely can't meet. And again, we use stops. So even though we use margin in our model portfolio, we have stops in place. And right now in our core portfolio, we've only got one position, trying to put on a second position. So even if we were to get a margin call, we've got plenty of money in our core model portfolio account to cover those margin calls. And that's exactly what you want. But retail investors, not really there. So they're going to have to sell things, winners, to make margin calls. And they're also very loaded in one or two stocks, the Teslas, for example, the Zooms, things like that. And when they're that leveraged and that one stock takes a hit, again, they have to try and find the money somewhere, and they don't have it. When the Wall Street Journal is writing stories about a guy who started with a $23,000 option investment, or even sold his house to put more money in these leveraged plays, and he ended up being a millionaire, and they're putting that on the front page as if it's a good story, that's when you're starting to see very toppy behavior in the market. Also, in terms of leveraged funds, leveraged ETFs, we have the highest level of ownership by retail investors since 2006. Remember what happened then? Sell-off. So be very careful if you're doing stuff outside the stock think tank. You should be. We shouldn't be the only investment you have. But be super careful about what you're doing out there. And again, watch for our plays, because our plays are designed to not win in a sell-off, but to protect you against these larger sell-offs. That's what we do with our stops and with our trailing stops. The two positions we have on, one is lows, which you should have. The other one is a special play. Both we've already moved the stop. And just like CVS, hopefully, if we get stopped out, I don't want to get stopped out, but if we do, we'll be getting stopped out for less than our original risk, which again is that design. We're going to end up beating the S&P by a lot in 2020, and we'll release that soon. And I will talk to you guys in the new year. Cheers, everybody. Be safe. Thanks for trusting us, and happy holidays.